when a company has been making losses, over a long period of time, it becomes difficult for that company to pay dividends. When a company has been making losses over a long period of time, we are saying it becomes difficult for that company to pay dividends to their shareholders. 2, it also becomes difficult for such a company to attract potential investors. Becomes difficult for such a company to attract potential investors. Of course, no investor would want to buy shares in a company where they keep seeing retained losses in the balance sheet every year. Such a company would not attract potential investors. That is the effect of a company which has been making losses over a long period of time. 1, it becomes difficult for that company to pay dividends. Number 2, it also becomes difficult for that company to attract potential investors. So we want to assume our company is company A. So the question now becomes, what is the most logical thing for such a company to do? Now that they have been making losses over a long period of time, what is the most logical thing for that company to do? The most logical thing for that company to do is for that company to reconstruct itself. And the aim of reconstructing this company is to help this company to eliminate. The aim is to help the company to eliminate the accumulated losses from the books of the accounts. We want to eliminate those accumulated losses. We no longer want, from now onwards, we no longer want to be reflecting accumulated losses in the balance sheet. No, we want to eliminate them from now onwards. So that's the aim of reconstructing a company. It's to help the company to eliminate the accumulated losses from the books and to enable that company from now onwards to start its activities in a more attractive and profitable manner. We want this company from now onwards to start its activities in a more attractive and profitable manner. So that's the purpose of reconstructing a company. Now the other question now is, how do we go about reconstructing a company? There are 2 ways in which a company can be reconstructed. One way is through what we call internal reconstruction. That's one way you can reconstruct a company, through internal reconstruction. And number 2 is through what we call external reconstruction. So that's another way in which a company can be reconstructed. Now, when we are reconstructing a company through internal reconstruction, when you want to reconstruct a company through internal reconstruction, the stakeholders of the company, all the stakeholders of the company will be called into a meeting. That's why we are calling internal reconstruction. Here, the stakeholders would include people like ordinary shareholders, preference shareholders, debenture holders, creditors, and any other stakeholder of the company. So that we ask ourselves, what are these stakeholders willing to sacrifice? What are they willing to sacrifice in order to help this company to reconstruct itself or to eliminate the accumulated losses? For example, the ordinary shareholders might tell us we owe them 30 million, but maybe they are willing to write off 3 million from their capital. Preference shareholders, maybe we owe them 20 million. They might tell us they are willing to write off maybe 3 million from their capital. Debenture holders, for example, they may tell us we owe them 40 million. They are willing to write off an amount of maybe 2 million or 5 million, whatever it is. So when it comes to internal reconstruction, I hope you are noticing that the aim of this internal reconstruction is to it is to reduce the capital of the company or the finances of the company. We had share capital amounting to 30 million ordinary. These guys were willing to write off 3 million. Preference shareholders, we owed them 20 million. These guys are willing to write off 3 million. The debenture holders, we owe them 40 million. They are willing to write off 5 million. So when it comes to internal reconstruction, we reconstruct the company through what we call a capital reduction scheme. The stakeholders will come up with a scheme that we call a capital reduction scheme. That's how we reconstruct a company through internal construction. So when it comes to internal reconstruction, the capital of the company is reduced. The capital of the company is reduced through what we call a capital reduction scheme. Capital of the company is reduced through what we call a capital reduction scheme. We call the stakeholders and ask them what are they willing to sacrifice in order to help this company to eliminate the accumulated losses. What are they willing to sacrifice in order to help this company to eliminate the accumulated losses? Good. Now, the second way of reconstructing, we shall come back to the first approach, but the second way of reconstructing a company is what we call, or through what we call, external reconstruction. Now, we are reconstructing this company called A. Now, when you are reconstructing a company through external reconstruction, then another company, let's call it company B, will come and buy the business of the company that is being reorganized. When it comes to external reconstruction, another company will buy the business of the company that is being reorganized. In other words, this company A will have to liquidate themselves. In other words, it has to be liquidated, and then they sell their business to this company B. This company B could be a newly formed company, or it could be another existing company. It could be another existing company. So that's the essence, in summary, of how to reconstruct a company through external reconstruction. We are saying through external reconstruction, company A is liquidated and they sell their business to another company, which could be either an existing company, or it could be a newly formed company, meaning you form company B so that they take over the business of company A. Good. That's how we reconstruct a company, either through what we are calling internal reconstruction or through what we are calling external reconstruction. Good. Now, let's go back now and discuss in detail how do we reconstruct a company through internal reconstruction. Now, when it comes to internal reconstruction, I have said the capital of the company is reduced. And therefore, some books would call this internal reconstruction. Some books will call it capital reduction. So when it comes to capital reduction, it's the same as internal reconstruction. So internal reconstruction, some books will also call it capital reduction. This is internal construction. So let's now discuss in detail how this is undertaken. How do you reconstruct a company through internal reconstruction? Now, I've already told you that when a company is reconstructed through internal reconstruction, the stakeholders of the company are called into a meeting. Stakeholders of the company are called into a meeting so that they tell us what are they willing to sacrifice in order to help this company to eliminate the accumulated losses. Already said, shareholders, for example, whether the ordinary or the preference, they may decide to reduce part of their capital. So now, what are the accounting entries now for internal reconstruction? Now, one, with the amount that we shall decide as a group of stakeholders, with the amount that we shall decide to reduce the share capital, with the amount written off on share capital, let me assume that our company had an account called ordinary share capital, which has a balance brought down of, let's say, 20 million. I also want to assume that this 20 million comprised of 2 million shares of shillings 10 each. 2 million shares of shillings 10 each. That's how it comes to 20 million. So as a group of stakeholders, we agreed, let the ordinary shareholders, or the shareholders called ordinary, decided they are going to write off maybe 1 shilling from their share. Let us assume so, that they decided they are going to write off 1 shilling from their capital. A share which was of 10, they decide to write off 1 shilling per share. So on their 2 million shares, they are going to write off how much? It's obvious. 2 million times 1, they are going to write off 2 million shillings. What is the accounting entry? What is the accounting entry? This is the accounting entry. Now, with the amount written off on share capital, you will debit that share capital and we shall be crediting an account we shall be calling capital reduction. In our case here, it's 2 million. So you will debit share capital and you will credit this account we call capital reduction. Just a minute. Let me push it somewhere here. Okay, so this is an account called capital reduction. We have debited share capital by 2 million, and now we credit this account we are calling capital reduction by 2 million. And we come and say ordinary share capital 2 million. Now listen, it could be preference shares. It doesn't matter. Maybe our preference shareholders decided to write off whatever they want to write off, but the point is this: whatever the amount you are writing off on share capital, you go debit that share capital account, because share capital is always a credit balance. You go debit that share capital and you credit this account we are calling capital reduction. That is our entry for writing off share capital. I have said it does not matter whether it's ordinary or preference. Okay? If it's preference, you will debit preference share capital, credit capital reduction with amount written off on share capital. Good. That's our entry number 1. Before we go to number 2, listen to this now. Before we go to number 2, there are some questions that may tell you this group of stakeholders decided. Remember, our company has shares worth 20 million shares, share capital of 20 million, which I have said comprised of 2 million shares of 10 each. Now, this group of stakeholders could have decided they want to write off the old shares, write off all of them, the old shares, and replace them with new ones. That could be another way. They decide, instead of writing off 1 shilling like we have done, they decide they are going to write off all the share capital, then they replace them with new ones. So in case of that nature, what do? Let me come and illustrate here. We have said, if you have this account called ordinary share capital, let me open another one here, ordinary share capital, which has a balance brought down of 20 million. These shareholders decided to write off the total amount, write off the old shares and replace them with new ones. So if they are writing off the old shares, they will debit share capital and credit the account we are calling capital reduction by that 20 million. Okay? They will open this account we are calling capital reduction. Let me squeeze one here, small one. This is capital reduction. And they will come and say ordinary share capital, 20 million. That is to write off the old. You debit ordinary share capital and you credit capital reduction. Okay? Then they could have decided to replace the old ones by issuing, listen to this now, by issuing another 2 million shares of 9 each. They decided to issue 2 million shares of shillings 9 each. So if they decided to issue 2 million shares of 9 each, then it means they are issuing shares amounting to how much? 18 million. They are issuing shares amounting to 18 million. Now listen, with the nominal value of the new shares issued, with the nominal value of the new shares issued, what should be the double entry? It will be, you will debit capital reduction, and you credit the account we are calling ordinary share capital. You debit capital reduction and you credit ordinary share capital by how much? By 18 million, and you credit this account we are calling share capital. Come and say here, capital reduction by 18 million. Now I want you to watch what we have said. Let me start from the second approach, the second way, where I've said the stakeholders decided to write off all the capital. So they had to debit their capital here and they had to credit capital reduction. Then they decided to replace the old ones by issuing another 2 million shares of shillings 9 each, which comes to 18 million. So they issued shares amounting to 18 million to replace the old ones. What they will do, they will debit capital reduction by that 18 million, debit that capital reduction by 18 million, and they will credit share capital by 18 million. Which is to say, listen, originally the capital was 20 million. They wrote off all of it. Then they replace it by issuing another share amounting to 18 million. Which means effectively therefore, this company is carrying down a share capital of 18 million. Originally they had a capital of 20, they wrote it off, then they replaced it by issuing the shares amounting to 18. Effectively, I hope you can see, effectively that is to say, they are writing off 2 million shillings, which is the same approach we had initially, where the examiner told you, you are writing off 1 shilling per share. Where we were told to write off 1 shilling per share, remember our company had 2 million shares and we were told to write off 1 shilling per share. So we had to debit share capital, you can see there, and we had to credit this account called capital reduction. We had to credit this account called capital reduction. Okay? That's what I want you to understand. Listen, let me go back. We have said we are trying to look at how to reconstruct a company through internal reconstruction. I've told you that when a company is reconstructed through internal reconstruction, I've told you the stakeholders of the company are normally called into a meeting so that they tell us what are they willing to sacrifice in order to help this company to eliminate the accumulated losses. I've told you one group of stakeholders could be ordinary shareholders or preference shareholders or debenture holders or creditors. For the shareholders, that's what we are discussing. Whatever they may decide to write off on their capital, whether it's preference share capital or preference share capital, whether it's ordinary share capital or preference share capital, I have said, whatever the question tells you you are writing off, go to that share capital account, whichever it is. In our illustration, we were assuming it's ordinary share capital. I was assuming the question told you our company had 2 million shares of shillings 10 each. That gave me a capital of 20 million. A group of stakeholders met and they decided to write off 1 shilling per share. And we have seen that means they are writing off in total how much? 1 shilling times 2 million shares, that's 2 million shillings. We have agreed you will debit share capital and you credit capital reduction. Good. That's the double entry. You debit share capital, you credit this account we are calling capital reduction. That's the most common way the examiner will give it to you. How much write-off per share. That's not the only way I say it. The examiner could test you. Okay? Say, still on the capital, the question could have told us that this group of stakeholders met and they decided to cancel the old shares and replace them with new ones. Yeah? I've also told you, in that case, therefore, you will go to the share capital account, cancel those old ones. We were assuming our share capital was here, 20 million. We are told by the question to cancel the old ones, so we had to debit share capital and to credit capital reduction with the nominal value of the old shares. Okay? Then the question could have told you they decided to replace the old ones by issuing another 2 million shares of 9 shillings each, meaning they are issuing shares amounting to 18 million to replace the old ones. Then we have said, with the nominal value of the new shares issued, you will debit capital reduction here, you will debit capital reduction, and you credit share capital. Then I've said, when you look at those two approaches, effectively, it's like you're writing off 2 million. First approach, the examiner gave you the amount write-off per share, so you have to compute the amount to be written off in total. The second approach, the question says, cancel the old and replace with the new ones. But we can see, effectively, both approaches, you're writing off 2 million, because if you use the second approach, the original capital was 20, you cancel it, you replaced it by issuing shares amounting to 18, so your company will continue now having a capital of 18 instead of the original 20. Therefore, it means you are writing off effectively 2 million. That's our entry number 1 when it comes to internal reconstruction. The entry is with amount written off on share capital. You will debit share capital and you credit the account we are calling capital reduction. That's our entry number 1. Number 2, as a group of stakeholders again, we met and we requested the debenture holders or even the creditors, what can you do for us? The ordinary have accepted, they're writing off something. What about you stakeholder called debenture holders or you creditors? What are you willing to do? So here we were assuming, suppose the creditors told us we owe them 40 million and they are willing to write off 5 million. So our second entry says, with amount written off on liabilities, with amount written off on liabilities, whichever the liability, it could be creditors, it could be debenture, it could be bank loans, whatever we are writing off. Okay? Our entry number 2 says, with amount written off on liabilities, with amount written off on liabilities, whichever the liability, go to that liability account. We know liabilities again are a credit balance, whatever the amount. Write off part of whatever the question will tell you to write off. How? By debiting that liability and you credit the account we are calling capital reduction. So with amount written off on liabilities, debit the liability to write off and you credit capital reduction, whatever the amount. Okay, good. That's our entry number 2, which says with amount written off on liability, debit liability, credit capital reduction. Good. Let's go to number 3 now. Let's go to our entry number 3. Now, listen. I told you when I was starting that the aim of reconstructing a company is to help this company to eliminate the accumulated losses. To eliminate the accumulated losses. Now, listen. To eliminate these accumulated losses, as a group of stakeholders, we could have met and decided to help this company to eliminate the losses. Why can't we revalue some of the assets downwards? Maybe machinery, motor vehicle, furniture, or building. Why can't we revalue them downwards, some of them downwards? That's our entry number 3 now, which says with amount written off on liabilities, with amount written off on assets, whichever the assets, building, motor vehicle, furniture, whatever. How would you write off part of that amount? You will go to the asset account, whichever the asset account, go there. We know assets are always a debit balance. We know assets are always a debit balance, balance brought down. Whatever the question tells you to write off, 2 million, 1 million, whatever, good. To write off part of the assets, you will credit the asset and you debit this account we are calling capital reduction. Number 3 says, with amount written off on assets. With amount written off on assets, credit the asset and you debit this account we are calling capital reduction. That's our entry 3, which says with amount written off on assets, debit capital reduction, credit assets. That's our entry 3. Good. Number 4. I have also told you the aim of reconstructing a company is to help this company to eliminate the accumulated losses. It means therefore, when you go to the P&L account of this company, you will find an accumulated loss. Losses, I hope you still know from your accounting knowledge, losses are always a debit balance. Losses are always a debit balance. Now, the aim of reconstructing a company is to help the company to eliminate the accumulated losses. I told you that once we reconstruct this company, we should not show in the balance sheet any accumulated losses. No. So they have to be eliminated. So our entry number 4 says, with these accumulated losses that have to be written off, what should be the double entry? You will credit P&L account and you debit capital reduction. You credit P&L account because losses are always a debit balance and you debit this capital reduction. That's our entry number 4, which says with accumulated losses written off. You will credit P&L account and you debit capital reduction and you debit capital reduction. That's our entry number 4, which says with accumulated losses written off, debit capital reduction, credit P&L. Good. That's our entry number 4. Number 5. Before I go to number 5, let me ask you a question. We are reconstructing this company, which I was assuming we're reconstructing a company called A Limited. Now, this company knew you as an accountant. So they called you and asked you to help them reconstruct themselves. So you decided, or maybe they decided, they are going to reconstruct themselves as from maybe 31st of December 2024. They are going to reconstruct themselves as from 31st December 2024. So you as an accountant, you will ask them, give you all the accounting information they have as at that date. In other words, collect information from the company as at that date. Ask them to give you their balance sheet as at that date, the income statement for the year ended 31st December 2024, and many other things that you need for the purpose of helping them reconstruct themselves. Now listen. Suppose in the process of trying to gather this information, you realize that this company, by end of 31st of December 2024, or rather that date, this company had what we call a contingent liability. When you were collecting the information of this company, you realized that by 31st of December 2024, these guys had a contingent liability. Now, I may not ask you to define a contingent liability, but I may want you to give me an example of a contingent liability. This is not a new term to you. You must have heard it before. So give me an example of a contingent liability. Chat and give me an example. There are so many. Chat and give me an example of a contingent liability that you have heard of. Yes. Any contingent liability that you know? Any contingent liability that you know? Yes. Any contingent liability that you know? There are many. Chat and give me an example of a contingent liability. I'm waiting. Yes, thank you, Joseph. So we are giving us an example of our pending law suits. That's correct. So let me use it. Let me use it. Now, as of 31st of December, 2024, listen, one of your suppliers, you as a company, took you to court. And your lawyer has analyzed. Remember, that case has not been decided yet. But your lawyer was saying that in case the company or the case goes against the company, in case the case goes against the company in the future, maybe as a company we shall be required to pay 2 million shillings for damages. As at 31st December 2024, we have a court case which is still pending. And the lawyer has analyzed and seen that if the case goes against the company will be required to pay 2 million shillings as damages. Alternatively, if the case goes in our favor as a company, then we may not be required to pay 2 million. Now, so that 2 million is an example of a contingent liability. Listen, if you go to the balance sheet of this company as of 31st of December 2024, you will not find, you go to the balance sheet of that company as of 31st of December 2024, you will not find a liability of 2 million in the balance sheet. No. In other words, we are saying contingent liabilities do not appear in the balance sheet. So before we talk about that, we also need to define now what's a contingent liability. Now that you have given me an example of a contingent liability, what then is a contingent liability? Listen. So we normally define a contingent liability as a liability which is likely to crystallize, in the future, depending on the occurrence or non-occurrence of a future event. It is that liability which is likely to crystallize in the future, depending on the occurrence or non-occurrence of a future event. If the case goes against the company, we shall pay 2 million. The case goes in our favor, we don't pay the 2 million. Are you there? Good. Now, but then, remember, this liability has not crystallized yet. It's a liability which is likely to crystallize in the future. And therefore, when you ask for the balance sheet as of 31st of December 2024, you will not see it in the balance sheet. Yet, as of 31st of December 2024, we have a contingent liability of 2 million, which is likely to be paid in the future. Now that we are reconstructing the company, listen to this now. Now that we are reconstructing the company, what do you do as an accountant when you come across such a contingent liability? You are now required immediately to crystallize it. when you are reconstructing a company through internal reconstruction and you realize that this company has a contingent liability, then you as a company, you are required to crystallize that liability. In other words, make it a liability. Make it a liability in the books now. It was not there before. Now it should be there now onwards. So in other words now, how do you record that transaction? So our entry number 5 says, with any contingent liability arising. With any contingent liability arising. Now, before I give you the double entry, let me give you another example of a contingent liability. You have given me a court case, which is true, but let me give you another example. Our company has preference share capital. Let's say we have a 10% preference share capital amounting to 30 million. Our company has a 10% preference share capital amounting to 30 million. You can see from here, this company is supposed to be paying the preference shareholders a dividend of 3 million. Every year they're supposed to pay dividend 10% of 30, 10% of 30, 10% of 30, which means every year they're supposed to pay 3 million. Now, our company has been making losses, don't forget. So if we have been making losses, it automatically means that we shall not be able to pay this dividend of 3 million to the preference shareholders. The question is this: will the preference shareholders still lose their 3 million? The answer is no. You know, there is what we call a cumulative preference share. Meaning, if your company has a cumulative preference share capital, then these preference shareholders will not lose their capital or their dividend, sorry. What they will do, they will just keep carrying forward. The company will just keep carrying forward that liability of 3 million. They know they have not paid the preference shareholders 3 million this year. Next year they make another loss. You know they have not paid another 3 million, and that way. So that in the future, when the company makes profit, they will pay all the arrears of the dividend. They will pay all the arrears of the dividend. Now listen. So let us assume that our company has not been paying the preference shareholders for the last 2 years. So that means in total, we have not paid our preference shareholders a dividend of 6 million. We owe them 6 million for their dividend. The point is this: if you go to the balance sheet of that company again, as at 31st of December 2024, we have not paid the preference shareholders their dividend for the last 2 years. Will you see a liability of 6 million in the balance sheet? The answer is no. Listen, whenever a company has not paid the preference shareholders their dividend, they don't reflect it in the books as a liability. What's that company normally do? The company will just keep carrying forward that liability. They just know we have not paid the 3 million last year. We never paid 3 million this year. Therefore, in the future, we shall pay 6 million. But that amount will not appear in the books. They just keep knowing it's an arrear amount. It's a dividend in arrears of 6 million. Now listen. Now that when you are collecting information, you realized that we as a company, we owe them 6 million. That is again another example of a contingent liability. That's another example of a contingent liability. It's that liability which is likely to crystallize in the future, depending on the occurrence or non-occurrence of a future event. If we shall make profit, we shall pay the arrears of 6 million. If we shall not make profit in the future, we keep carrying it forward. So another example of a contingent liability is what we call preference dividends in arrears. Preference dividends in arrears is another example of a contingent liability. Listen, for your exam purposes, this is the most commonly used example of a contingent liability, where the examiner will tell you somewhere in the additional information that the company has not paid the arrears last 2 years, 3 years, and so on. So the question was, what do you do with any contingent liability that arises? Whether it's the court case, whether it's the dividends that are in arrears, what do you do? That's our entry number 5. Again, listen, I have already said, moment you realize there is a contingent liability in your company, you have to crystallize that liability. You have to crystallize that liability. So the question was, how do you crystallize it? Make it a liability. So you will go and credit this account we are calling contingent liability. You credit, because a liability is always a credit balance, and you debit the account we are calling capital reduction. Capital reduction. You will go to the capital reduction account and you debit that capital reduction account, and you come and say your contingent liability. If you know the name of your liability, specifically like now we know it's preference dividends in arrears, then you will debit this capital reduction and you will credit the account we are calling preference dividends in arrears. So whichever the name of the contingent liability, you can now open an account in the specific name. That's what I was saying. Otherwise, in general, we are just calling it capital or contingent liability. But if you know the name of your contingent liability, then you open the account in the name of that contingent liability. Now listen. The question could go further and tell you that this company has a contingent liability of preference dividends in arrears of 6 million. Now that we are reconstructing, the directors decided they are going to pay that liability immediately. The first thing they did was to crystallize. Then we are going on to say, if that contingent liability is paid for immediately, then you will debit contingent liability and you credit bank, whatever it is. If the question tells you it was paid for immediately. Or you paid it, remember it was not in the books. What do you do first? This is important. You crystallize it first. Make it a liability. How do you make it a liability? By debiting capital reduction and you credit that contingent liability. Then I've gone further and said, if the question says it was paid for immediately, then you debit that contingent liability and you credit bank. That's our entry number 5, which says, with any contingent liability arising, you will debit you will debit capital reduction and you credit contingent liability. If it's dividends in arrears, you credit preference dividends in arrears. Then I've said, if it's paid for immediately, then you debit contingent liability and you credit bank or cash, whichever the case might be. Good. That's our entry number 5. Number 6 and the last one. 6 and the last one. This. Now, we have been opening this account called capital reduction. This capital reduction is our operating account. This capital reduction is our operating. Whenever you are dealing with internal reconstruction, the operating account is capital reduction. Now, after you have implemented the scheme that the stakeholders came up with, then listen, this account, after you have implemented the scheme, this account, normally it should be self-balancing. After implementing the scheme of capital reduction, that account should be self-balancing. But there are times when this account may not balance even after implementing the scheme. And so our entry number 6 says, in case there is a balance in this account, which in some cases you find it on the debit side, how do you treat that balance? In case there is a balance in the account we are calling capital reduction, that balance should be considered as a capital reserve. Should be considered as a capital reserve, meaning take it to the account we are calling capital reserve. You debit capital reduction and you credit capital reserve. That's our entry number 6. which says with any balance remaining in the capital reduction account, any balance remaining in the capital reduction account will debit capital reduction and you credit capital reserve. Good. Those are the 6 accounting entries when it comes to internal reconstruction. Let me go through them again very fast because I want to ask you a question. But let me go through them again. Number 1, when a company is being reconstructed through internal reconstruction, 1 we have said, with amount written off on share capital. Whether the capital is ordinary, preference, said you go to that share capital account, whichever it is, you debit it and you credit capital action. I started by assuming you to write off 2 shillings or 1 shilling per share or whatever the question will tell you. We know share capital as well as a debit balance. You debit share capital and you credit capital action. Good. That was our entry number 1. Number 2, we said with amount written off on liabilities, whether the liability is creditors or debenture holders or bank loans, whichever liability these guys are deciding to reduce. Go to that liability account, we have agreed, debit that liability, and we have credit capital action. That was our entry number 2. Number 3, we have said, when this group of stakeholders met, remember the aim of reconstructing this company is to help the company to eliminate the accumulated losses. So, they could have decided, why can't we revalue some of our assets downwards? So, they decided, let's reduce machinery, furniture, building, and so on. So we said number 3 is, with amount written on assets, whichever assets, said you debit capital reduction, you have said, and you credit the asset. That was our entry number 3. The amount written off on assets, debit, capital reduction, credit the asset. Number 4, said what's the aim of reconstructing this company is to help the company to eliminate the accumulated losses. Said when you go to the P&L account of this company, you will find a retained loss. Said retained losses are always a debit balance. And because the aim is to eliminate the accumulated losses, then you have to write off them. You will credit P&L account with whatever the accumulated losses are, and you debit capital action. That was our entry number 4. It says with accumulated losses written off. Now, before I go to number 5, listen to this now. Some of your questions do not remind you to write off the accumulated losses. Some of your questions don't remind you write off. They will tell you how much write off on share capital. They will tell you how much write off on liabilities. They will tell you which assets to be reduced and so on. But nowhere in the question will you be reminded or be told write off the accumulated losses. Listen, some questions don't talk about it. But remember, the aim of reconstructing the company is to do what? Said the aim of reconstructing this company is to do what? Is to eliminate the accumulated losses from the books so that we enable this company to start its activities in a more attractive, profitable manner. Listen. So the point is here. Whether the examiner reminds you or he does not remind you to write off the losses, whether the examiner reminds you or he does not remind you to write off the losses, you should remember write off those losses. Whether it's reminded to you or not given to you, it's your responsibility to remember the aim of reconstructing this company, write off the accumulated losses. So you have to remember, write off those accumulated losses. Some questions tell you, some don't remind you. Even though they don't remind you, you have to remember, write off the accumulated losses. Good. And I've talked about number 5. Said, when you are reconstructing this company and you realize that as at the date of reconstruction, this company has a contingent liability, e.g., preference dividends in arrears. That's the most commonly used example. Said, you will debit capital reduction, any contingent liability, debit capital reduction, and you credit that contingent liability. Said, the examiner gives you the name of the liability, preference dividends in arrears, and you credit the account we are calling preference dividends in arrears. And I've said, if the question tells you it was paid for immediately, then debit capital reduction, you'll debit that contingent liability, whichever it is, credit. Good. That's our entry number 5, with any contingent liability arising. Finally, number 6, I've said, in case there is a balance in the capital reduction account, that balance, I've said, should be considered as a capital reserve. Therefore, you will debit capital reduction and you credit capital reserve. You debit capital reduction, credit capital reserve. Good. Now, before I proceed now, let me ask you a few questions. I've taken you through the entries. Now I want to use the same entries to ask you a few questions. Number 1, said, whenever a company is reconstructed through internal reconstruction, the stakeholders are called into a meeting. So we called the stakeholder by the name ordinary shareholders. We owed them 20 million. These guys were willing to write off 2 million. What did we do? We debited share capital by 2 million and we credited this account called capital action. By how much? 2 million. Listen to my question now. To the company. Listen. To the company. Is that a gain or a loss? To the company. Is it a gain or loss? Chat and tell me. To the company. Is that a gain or a loss? We called the stakeholders. One of the stakeholders we called were the ordinary shareholders. They were willing to write off 2 million from their capital. We debited share capital and we credited capital action. So the question is that a gain to the company or a loss to the company? Chat and tell me whether it's gain or loss. Do you think it's a gain or do you think it's a loss? Called the stakeholder by the name of ordinary shareholders and they were willing to write off 2 million from their capital. We debited share capital, credited capital reduction. Yes. To the company. Is that a gain or is it a loss? Good. Thank you. I've managed to get it. It is a gain. It is a gain. Why is it a gain? The reason is we owed them 20 million initially. They are writing off 2 million. So from now onwards, as a company, we only owe them 18 million. So to us as a company, that is a gain. Number 2, we called in the creditors or the debenture holders and we asked them, what can you do for us? We knew we owed them 40 million here for that liability. These guys were willing to write off maybe 3 million. So we had to debit liability called creditors or debentures. The 3 million, we had to credit capital reduction. The question again is, to the company, to the company. Is that a gain or loss? To the company, that a gain or loss? According the creditors or the debenture holders, you are willing to write off 3 million. So we debited debentures account, we credited share capital by 3 million to the company. That a gain or is that a loss? That one give me. Good. Gain, it's a gain. Thank you. That's correct. Why is it a gain? Because again, initially we owed them 40 million. Now we no longer owe them 40 million. We owe them only 37 million. Because we have written off 3 million. Good. The company, that's a gain. Number three, I say, we have to call in the stakeholders and we ask ourselves, how can we help this company? So we decided, let's revalue some assets downwards. Maybe machinery, vehicle, furniture, or building. So let us assume it was machinery. We went to that machinery account, which has a debit balance, to write off whatever. We credited that machinery account, and we had to debit capital reduction. So when we wrote off whatever we wrote off on the assets, to us as a company, is it a gain or loss? To us as a company, is that a gain or loss? Good. Thank you. That's a loss. Thank you. That's correct. Why is it a loss? Because as a company, our assets are going down. Our assets going down. Good. Let me jump to number 5, where we had a contingent liability. Listen, I told you, when you are reconstructing a company and you realize the company has a contingent liability, say it, that contingent liability will not appear in the books. It will not appear in the books as the 31st of December 2024. No. But now that we are reconstructing the company, we said we must crystallize it and make it a liability. How did we crystallize it? We had to debit capital reduction and we had to credit this account we were calling contingent liability. Whichever it was. Where was it? Here. Question is this. By me debiting capital reduction and crediting this account called contingent liability, in other words, by us crystallizing that liability, by us as a company crystallizing that liability, is it a gain to us or is it a loss to us? Listen to the concern. I have said they don't appear in the books. Contingent liabilities don't appear in the books. Now that we are reconstructing the company, say we must crystallize it. To crystallize it, that means to make it a liability, we have to debit capital reduction and we have to credit that contingent liability. By doing so, question is that a gain to us or a loss to us? Good. Thank you. You have also managed to get it. That is a loss. Why is it a loss? Listen. Why is it a loss? Because before we reconstructed the company, before we started reconstructing the company, this company did not have a liability in the books. Before we started reconstructing the company, that company did not have a liability of 2 million in the books. But after we start reconstructing the company from now onwards, 2 million shillings will be reflected in the books. Meaning, our liabilities are increasing as a company. When liabilities are increasing, that automatically means that as a company we are suffering loss. Good. That will give us a loss here. Now listen. From those 4 entries alone, from those entries, 4 entries alone, I hope you can see a pattern. Hope you can see a pattern. Pattern I hope you have noted is this. Every time our company made a gain in the process of reconstructing our company. That gain was credited in the capital action. Every time the company made a gain, that gain was credited in the capital action. Therefore, hope you have noticed, every time our company made a loss in the process of reconstructing itself, that loss was debited in the capital action. Okay? That's what you have noticed. Now, I've given you that illustration so that, listen, sometimes you go to the exam and you are given this question of internal reconstruction. Listen, and among the additional information items you are given, there could be some items or transactions you are given which are not among the 6 official entries that I mentioned. I have mentioned 6 accounting entries here. But there are times when a question may give you a transaction which is not among the 6 accounting entries. But when you analyze that transaction, whichever it is that the examiner has given you, you realize that our company, after we have implemented that transaction, our company will make a gain. So that gain, whichever it is, should be credited in the capital action. Let me give you an example. Some questions may tell you share premium to be written off. As an additional information number 7 or whatever in the question, share premium to be written off. There is nowhere we have mentioned premium before, but now the question is telling us to write it off. So you will go to that share premium. We know share premium is an amount that belongs to shareholders, part of equity. Whatever the amount that we are told, write off. You will debit that share premium account and you will credit this account we are calling capital action. You will debit share premium, and you credit this account we are calling capital action with the amount we are calling share premium. If the question told you share premium to be written off, and we are saying it's a gain because this being an amount that we owe to the ordinary shareholders, part of equity. Now that we are writing it off, then it means as a company, we owe our ordinary shareholders less. So as a company, we are gaining. So we gain, that gain should be credited in the capital action. Giving you an example, share premium to be written off. Another example could be general reserves to be written off. We have not mentioned any general reserve somewhere. Or you could be told the revaluation reserve to be written off. Maybe in the balance sheet of this company, there is a revaluation reserve to be written off. So those are components that belong to shareholders. If we are writing them off, then as a company, we are gaining. Why? Because we are reducing what we owe the ordinary shareholders from their equity components. Good. Then you go to the next additional information as per the question, and you are told, listen, to reconstruct this company, it's costing us 2 million shillings as reconstruction cost. Somewhere in the additional information, you are told the company spent 2 million shillings for reconstruction of the company. Meaning, we are spending 2 million for reconstruction of this company. So the question again is this. It's not among the 6 entries. But as a company, is it a gain to us or is it a loss to us? It's obvious. If we are spending money to reconstruct our company, then as a company, we are losing. So that loss will have to be debited in the capital action. So with that amount, which we are giving an example of amount spent for reconstruction of the company. In other words, with the amount incurred for reconstruction cost, you will debit the capital reduction by that 2 million and you will credit bank because you are spending 2 million. That reconstruction cost, whatever it is. So that's an example of a loss that your company is suffering. Therefore, that loss should be debited in the capital reduction. Because we are spending money, you will credit bank. Good. So I've given you other examples of transactions that may not be given to you or we have not mentioned them, as part of the 6 official accounting entries. But I hope you have noted that how do you know whether it's a gain or loss? If it's something as a company we are gaining, said that gain should be credited in the capital action. If it's a loss, that loss should be should be debited in the capital action. Good. I hope you are so far together up to there. I hope you are together up to that point. Hope you are together up to that point. You can say yes, or if you have a question, I hope we are together up to that point. Yes, good. So, thank you for that, for saying we are together. Now, so today, I just wanted to introduce this topic. Maybe we shall continue from there next time. Let me continue with some more information here. Now, some of you are watching me through YouTube. Some of you are watching me through Zoom. Now listen. Tell your friends that we have online classes for the following subjects. We have online classes for advanced financial reporting, like the one we are doing now. Tell your friends we have financial reporting, online classes for financial reporting of the intermediate level. Tell your friends we have online classes for financial management of the intermediate level. And we also have financial accounting of the foundation level and the one of ATD1 and ATD2. In ATD1 and ATD2, there is also accounting. Now, if your friends are not able to join the live class, or if you are not able to join the live class, then you can buy what we call the pre-recorded videos. You can buy the pre-recorded videos for the whole syllabus, where you watch them at your own free time, at your own pace. Whenever you have a question, call me anytime. I will assist you. Can't be able to join the live class, and you can buy the pre-recorded videos where you watch them at your own free time. If you want to reach me, you can call me on this number 0722 65 8875. 0722 65 8875. Have to use the country code. It will be 254 722 65 8875. Call me. Currently, we are charging 4,500 a unit, and we also accept payments on installments. Call me if you want to pay in installments. We can discuss. Good. Now, for those of you who are watching me through YouTube, and you have not subscribed to my YouTube channel, please click that subscription button and subscribe to my YouTube channel so that you can be notified whenever we post new videos into YouTube. My YouTube channel is called CPA Joseph Guna. That's the name of the YouTube channel, Joseph Guna. Okay. You can also like this video. Click that like button. Like the video. Click that like button. Like the video. Otherwise, Joseph, you have said great. Hope you have understood something from this class. Joseph, hope you have understood something from this class. Joseph says yes. Yes, thank you. Thank you for that comment. But it is great. Lesson was great. Maybe we can stop there. If somebody has a question or a comment, and chat. Otherwise, somebody has said it was a great lesson. Thank you. Yes, there is another question. We can stop there. Pick it up from there. But for those who are watching through YouTube, please go and subscribe. If you have not subscribed, click that subscription button and you subscribe so that you can be notified whenever we post new videos into the YouTube. And I've said, tell your friends that we are offering online classes. These 4 subjects. One is advanced financial reporting of the intermediate, financial management of the intermediate, financial accounting of the foundation, and the one of ATD1 and ATD2. Then we have said, can't join the live class, can buy the pre-recorded videos. The content is the same. You'll be able to watch the videos at your own free time, your own pace. And we have said, and reach me through this number, 0722 658875. Good. Then subscribe. Is there a timetable? Yes. You can call me after this. Need the timetable? Need the timetable? Call me. Just call me after this. Yes, you are asking whether there is a timetable. Call me after this. We can discuss. Okay? Are you okay with that? Somebody's asking me whether there is a timetable. Call me. Okay, fine. Maybe we can stop there. Pick it up from there next time. Thank you for watching the class. That's bye for now. See you next time. See you next time.